which is funding your game development project. So I will talk a little bit about the investment climate and specifically the M&A climate for games out there, but I'll really spend the bulk of time to kind of talking about the funding aspect and how to get your game idea or your company funded. So a little bit about me. Thank you for that great intro. My background is in games. I started a company called Sandlot Games in 2002, sold it in 2011. Prior to that, I was a Wild Tangent. I was at a company called Kesmai. How many of you have heard of Kesmai? I know you have. Right. And that's where I got my start. So my entire existence has been in the gaming industry. And a couple years ago, I made a pivot into investment banking. I joined a company called Corum Group, a great outfit here in Bothell. And we're focused on selling companies, and some of those are gaming companies. It's a great change, and there's another presentation that I do on actually kind of that transition into that work from a personal perspective. But I won't get into that. I won't bore you too much with those details. So with that, let's go ahead and launch. Kind of talk about where gaming is from a valuation perspective. Continues to be pretty steady from a kind of top-line revenue. So we'll often in investment banking talk about top-line and bottom-line revenue, what we talk about, the sales multiple and also a revenue multiple. And so what's really interesting is that while it's from a top line, the amount of money that you get from selling your whatever it is, your freemium goods or the number of units, to the profitability side, which is the bars on the slide here, you see a little bit of a difference. So what's happening is that Wall Street is starting to value companies more on their profitability, specifically with regards to gaming, because of some of the latest questions regarding profitabilities of companies like Zynga and King. And so EBITDA multiples have become important and are valued higher in the gaming side. Top strategic acquirers. We track these on a half-yearly basis, so you're seeing numbers from 2014. You know, they hasn't really changed all that much from the number of deals perspective. So you still see Google, Yahoo, and Facebook really dominating from an M&A perspective. And certainly in the transactions in the gaming ecosystem. One thing that's really interesting and different is, you know, you can look at the deal counts, but also look at the billion-dollar type of deals out there. You know, those are tremendous, and there's a tremendous rise in the billion-dollar acquisitions. You know, and kind of sub-billion, 500 million and up, IGT, Bally, especially with the gaming companies out there. In the casino space. So a lot of the casino manufacturers, you kind of wonder, why are companies like GTech and IGT, why are they going out there and buying up games companies? Well, if you think about it, the traditional gaming casino manufacturers and casino companies out there, they're seeing a demographic crisis, right? And the demographic crisis is people aren't coming into the casinos. So what are they going to do, right? They have to supplement that by getting some of the millennials and other younger groups into the gaming ecosystem. They're going to do that online, and they're going to spend for it. This is where the M&A activity is happening. So strategic gaming acquirers, of course, Mojang going to Microsoft is the big news of 2014. Twitch going to Amazon. You're seeing a lot of games companies, but at the same time, you're seeing even more companies in the gaming ecosystem, essentially providers of gaming technology. And this is where the activity has been in 2014. Clearly, some of the bigger deals out there, including the acquisition of Oculus by Facebook. What's interesting in this particular slide is that since that acquisition, Oculus has gobbled up a number of technology companies, whether it's hand tracking with Nimble VR or a 3D model creation with 13th Lab. These are all acquisitions that really enhance the or have the potential to enhance the Oculus platform and continue to build on that investment that Facebook is making, right? Not exactly. I keep going back and forth. That's kind of funny. Okay, so deal volume is the highest since 2009. Again, a little bit more detail on that. Second half of 2014, $7.85 billion. On 2015, we're set to outpace that. The average deal size is trending upward as well. How that impacts you guys, you as a gaming company, as someone that has sold their studio, it's harder actually nowadays to sell a small gaming studio than ever before. You really have to get into a level of scale that you didn't have previously. And so this is something that you need to keep in mind, right? You need to work on your top line revenue. You need to look at your profitability. Focus on your business. There are a lot of studios out there. There's a lot of gaming properties out there, but you really need to get into that high growth curve before you get significant interest, from both an investment and a M&A activity. So top gaming transactions, of course, you see the big ones there with Oculus and Facebook, Mojang with Microsoft, Twitch with Amazon, Big Fish locally, of course, going to Churchill Downs. These are large deals that are happening very much in our space and continue to increase. Especially, you're starting to see a lot more Chinese flags out there. China is making an investment into the West and buying up U.S. studios. Okay, I think this is more important for you guys. So let's talk about what the pyramid of game development is from a funding perspective. When I started Sandlot, I was fortunate enough that the market itself was such that I could build a game, put it out there with distribution providers, whether it's Microsoft or Gamehouse, Real Networks at the time, or anybody else, and they would provide the marketing associated with that. I clearly will give them all the assets and all that other things, but we didn't really have to pay for the marketing. Well, guess what? Now you do. And it creates both an opportunity for a successful game, but also a challenge for trying to size up what it's going to take to develop a game. Because when you think about what it takes to develop a game, you also have to think about what it's going to take to market the game. From a perspective of marketing and promotion, traditional PR, product marketing endeavors, user acquisition is costly. The latest indexes I've seen in mobile, specifically, $3 per user. If you're working with Steam and PC development, how are you going to promote? How are you going to create that user base that's going to be really interested in your product? Games as a service, right? That's a new term. What does that mean? Well, that means that you have servers to maintain. You've got all these things that you have to do to make sure that your game continues operating on a perpetual basis. Otherwise, your user value goes down. Multi-platform, scaling up to not just mobile, to PC, to other platforms, and of course there you go, the hosting and server fees at the end there. So the funding options I quickly talk about are bootstrapping your company, crowdfunding, getting a publisher, angel financing, and VC financing. So I was, when I first started Sandlot, I bootstrapped. I finally decided to go out there and get a Series A through my advisors to kind of boost up production. And that happened after we took our company to market in 2008, and the market really wasn't there for acquisition at all. So we decided to double down and continue development, and I got some funding in. But when I started bootstrapping, the beauty of that is you do get to keep your equity. You get to keep your company. You get to keep your IP. You have flexibility. You can do whatever you want. You can build on whatever platform you want. You can just it's yours for the taking. The cons are personal financial risk. I mortgaged my house twice when I was working on Sandlot, right? So you kind of have to do that. And if you're passionate about what you do, that goes with the territory. And of course, the self-publishing costs associated with marketing. Common pitfalls are running out of money. I don't know about the recent stats, but for the numbers that I heard for 99 companies that start out, there's only, or for 100 companies that start out, there's really only one that is able to continue operations, because most of the time you run out of money from a bootstrapping perspective. You fail to project how long it's going to take and how much it's going to cost to develop a game. And specifically, you fail to figure out what it's going to cost to market and to promote and to acquire users and do all these things that are required to continue operations. Crowdfunding it is a good option. You get to keep your equity, you get to keep your IP, you've got money for development, you get to focus on your project, but now you've got a captive audience, provided that you're successful with your Kickstarter campaign or your Indiegogo campaign or whatever. You've got a captive audience. You've got it's good. It's marketing. It's built-in marketing associated with it. But you've got to keep those people happy. All of a sudden, you have 20,000 project managers out there in the form of your Kickstarter backers that are all trying to tell you what your game should look like. No, I want it pink. So 20,000 people yelling, no, I want it pink. How are you going to manage that? Think about it ahead of time before starting down the path of crowdfunding. So you do have less flexibility to change direction. If you tell them it's going to be pink and you're going to change it to blue, you'd be amazed how pissed off people will get. You're funding the project. You're not funding the company. Remember that, right? So you're funding the specific thing that people are paying for. So you got to deliver that. But whatever happens to your company, well, that's a secondary issue. Now, only specific types of projects do get funded, right? So when I had my casual game studio out there, I was looking at Kickstarter as an option. Not really an option for us. If you're working on a hardcore game, if you're working on a tabletop game, these are all options where the audience is there from a crowdfunding perspective, from a platform perspective, to get your project funded. Pitfalls, here's one, Yoga Ventures Kickstarter project that was canceled after $500K of funding. The problem is, if you don't deliver what you've promised and you've underestimated the effort involved with keeping that community happy and consistently happy and delivering them pink, then I think there's an opportunity there for failure. No matter how much money you raise, think about it, about 50% of that money coming from a Kickstarter campaign or from an Indiegogo campaign, essentially going to the community, keeping them essentially satisfied, whether it's the tchotchkes that they've ordered from you, the T-shirts, the figurines, or what have you, all the way down to actually having a community manager manage those that new set of users that you have to make sure that they're there, but also know what you're getting into from a development perspective. Getting a publisher is an option, right? You do get to keep your equity. You get money for the development. You get to focus on your project. Instead of 20 to 30,000 project managers, you're usually probably going to have 2 to 3, and they're going to have 2 to 3 bosses, and their bosses are going to have 2 to 3 bosses, all the way up. However, there's less people that you have to make happy. The cons are you're likely to lose that IP. Most of the publishers that you're going to talk to are interested in either being the acquirer of the IP, right, or owning the IP outright, or having some sort of rights associated with the IP, whether it's first right of refusal, what have you, some way that they can actually leverage the IP for further development. So you have less flexibility to change direction, right? So you have one type of game. You've convinced the publisher that you should fund me $500,000, please, for this type of game that I wasn't developed. You want to change direction, you go back to the publisher with a new scope document. It's going to be kind of an uphill road. They may go for it, but again, it's just, you don't have the same flexibility as if you were doing it on your own. Again, you're funding the project and not the company, right? So your company doesn't get to work on 2 to 3 SKUs as a result of a single publishing endeavor, unless you build in the margin associated with that particular development. Common pitfalls, so not carving out revenue or future versions. So you're stuck in a work-for-hire cycle. It's very easy. It's a common mistake that people make, thinking that publishing is great because it's not work-for-hire. Well, if you're not carving out exactly what you want to be left with after that publishing relationship, it is very much a work-for-hire type of relationship. You're not delivering on time and on budget. That's a huge pitfall because, again, that can impact the project. And publisher will also oftentimes not deliver what is promised, whether it's as far as marketing commitment or even milestone payments, right? And making sure you're contractually ironclad on that, but also, you know, it's something that you'll have to navigate. Negotiating on IP. What happens in a live environment? We talked about games as a service very, very briefly recently, right? So you launch a game, that game continues to operate. Who pays for that? How do they pay for it, right? What percentage of your staff is going to be allocated to it? For how long? Under what metrics? Under what conditions? All these things need to be figured out. Future M&A concerns. So, you know, if you got a game company and you've got 3 to 4 games coming up, but all of them are under essentially a first right of refusal from a publisher out there, your likelihood for successful M&A is limited, because all of a sudden any acquirer is going to look at you and say, well, wait a second, we can't have any of these things, because all of these things that you've got, all these games that you're working on essentially are going to go to this publisher, so the value to the acquirer is 0. Right, so be careful carving out future versions, and publishing relationships do have an impact on your valuation. Angel financing, I did go with angels after I raised my round in 2008. You've got money for development, flexibility to grow, or your company or pivot. You're funding the company, not the project, right? You have the flexibility to switch projects or even pivot your company entirely if that doesn't work for you. The cons, of course, are a loss of equity, right? So the angel investors are likely to want to have a significant portion of your company, but also on a preference. What that means is they'll get paid out before you do in an endgame scenario. So now your focus shifts from, okay, I'm building a game, I'm doing all this great work, and enjoying there, having fun. At the end of the day, when you take in somebody else's money, and I cannot stress this enough, when you take in somebody else's money, you have a responsibility. That's your primary responsibility, is to get an ROI on the investors' money that they're putting into your company. That is your number one responsibility as a CEO. And you do it however you can, right? You can still do that while having fun, but remember that your focus shifts. Common pitfalls, I often talk about the valley of death. It's the valley that exists between angel financing and VC financing. So again, 9 times out of 10, you run out of money before you are ready or scaled up to the point that you're of interest to venture capitalists, right? So you're not yet a $30, $50, $100 million company. You may be $1 million, $2 million company. You can go out there and raise any more money, but you need to. So what do? This is what we call the valley of death. That's an issue that is pretty active in the investment community. I think it's not so much an issue in the Bay Area as it is in kind of the secondary investment markets like Seattle. But yeah, this is something that you have to be careful with. When you take in angel money, be frugal, because you have to get across this valley of death before you're of interest to VCs. And we'll talk about what VCs are looking for in a second. If you don't project how long it will cost and how long it will take, you'll get into the valley of death. Not setting up for future rounds or potential exit environments. If you got too much of a preference wall, that is to say, there's all these investors that are going to essentially need to be paid out before any future round or any M&A opportunity. Say, for example, I've got a company that I'm working with that has taken on $15 million of investment, and they're a $3 million run rate company, right? So essentially, you have to be north of $15 million before the founders see a dollar, right? Okay, so be careful when you're taking on other people's money, because for the most part, they will get paid, they will need to be paid off first. So you need to be setting yourself up to success for that. A lot of times with angels, a lot of times they're very, very sophisticated, but sometimes they're not. So money does not necessarily come with expertise or the connections that you need to grow your business. VC financing. The pros on that are, if you get into a scenario where you can get VC funding, you're north of 10, 20, $30 million on a run rate. you have more than enough money to execute your plan with flexibility to grow or pivot your company in the future. You're investing into the company, not the project, so you have the flexibility to switch projects or switch, completely switch directions in the future if you see a better opportunity in the future. Cons are substantial loss of equity. You thought, getting angel money in is going to change your cap table. Your equity structure is gonna change significantly, and you're limited to significant exit targets. VCs are not interested in base hits. I guess that's a good way of putting it, right? So when angels are out there, they put in a couple $1,000,000, you sell for $5 or $6 million. That's a pretty good exit. VCs are not interested in a 2x, 3x sale, right? 2x of your revenue, 3x of your revenue. They're interested in 10x, 20x sale, and they're willing to roll the dice, whether you are or not, right? So you need to be really, really confident that you can build, $100 million, $200 million, $1 billion business with the VC investment. If you're willing to kind of go down that path, VC financing is for you. So common pitfalls: you don't scale to that $100 million business, right? That preference wall, and we talked about with angels, it is even more so the case with VCs, may keep you from a more conservative exit down the road. A base hit is really no hit for these folks. VCs, and the VCs for the most part, I went out there and I tried to raise VC funding. I know some folks in the audience have gone down that path too. At this point, VCs are still very much uncomfortable with the hit or miss nature of game development. And that continues to play out as VC investment has gone down in 2015. Exits have gone up. It's a paradox. Exits have gone up in value. However, VC investment has gone down. Okay. That was a rush. There was a rush of information, but what I want to do, how much time do we have?
We have 5 minutes for questions. If you have a question, raise your hand, and we can either give the mic to you, or we can paraphrase the question for the camera.
Yeah, I can paraphrase too. So.
Okay, well, I will start with a question.
Yeah.
As an investor, do you like red oceans or blue oceans? The idea of there's a million apps on the App Store, so somebody coming in and developing yet another app on there is a chance where a slice of a large market. Or you mentioned sort of virtual reality, where if you sort of do very well, you can be one of 10 or 20 must-have apps on this new platform, but there's a chance the platform might not be as successful. What are your feelings about whether you go for an established market or try and go for the niche product that could be really big?
Yeah. So let's go back to that idea where the investment climate is best. And certainly the reddest ocean out there is mobile game development, right? So if you're a mobile game development studio, you're competing with hundreds of thousands, a million other contenders out there. From an M&A perspective, companies that we take to market, game companies that we take to market, mid to hardcore original IP games tend to be the ones that are really interesting. Now, mid-core, I mean, I think the term mid-core is kind of bullshit. I mean, it's really kind of going back to that to the fundamentals of game development, where it's first-person shooters or real-time strategy games or hardcore strategy games. Those are really interesting. PC game development, if you are a good publisher on Steam, if you've built up value there, if you've built up margin there associated with that, that's a bluer ocean than mobile. But certainly the bluest of the blue is virtual reality. If you're building up some sort of virtual reality expertise, that's of tremendous interest to potential acquirers and also from an investment perspective. Because really, we're all game people here, even me. You may not think so. I used to not wear these, by the way. But the reality of it is that designing for virtual reality is completely different than designing for any other platform, right? So there's a lot of learning that needs to happen along the way for the folks to do it right. Okay, so if you're able to do it right, there's value there. Obviously, things like wearables and whatever the fancy new gadget is going to continue to be the drive some interest. There's been a couple developers that announced games on the Apple Watch. But certainly, if I was to make a bet right now, and I'm not going to, I've done too many bets right now. I'm pretty happy in letting other people do their bets. But if I was to make a bet, it would be in virtual reality, and seeing if you can go out there and go talk to Facebook or Oculus or Go out there and talk to Sony or Valve and get your game operating within these new platforms. You'll build some value in your studio that way. And one thing before we go, that also social casino. Social casino is one that used to be fairly blue just a couple years ago, when my friend Greg Annell started a company called Double Down, and was able to buy Facebook ads for 20 cents and convert that to an LTV of $30 to $40. That's no longer the case. Buying a casino user, buying from a user acquisition perspective, is pretty expensive. So it's become fairly red as well. So unless you have a new angle on the casino side of things, you'll find yourself kind of in a very difficult situation on that as well, from just getting noticed. Yeah.
What do you see as the minimum spend for bringing a new mobile IP to market in terms of user acquisition and marketing money you'd need?
I'll answer with my own failure. How's that? Okay. Because I used to think, okay, I get in about 1.2, 1.3 million. That's enough, right? So you cover about 400, 500K of that in expenses, and the rest in marketing. If you think about it, it really is what you get to first, minimum viable product, and from that minimum viable product, you're getting at some data associated with, specifically mobile, right? So you're at, say, your LTV is now $1.50 or $2. You know that to acquire a user, it's going to take $3. So you've gotten your development costs, you've captured your development costs for a year, right? So then basically you're saying, we need to go take this game back into development, or maybe it's just not working at all, we need to start something else, right? So it's a crapshoot, right? But say you've got something that's moderately successful, it's going to take you at least $1 million to actually market it on the App Store to generate any significant revenue.